In its recent rate decision, the Fed held rates for the 5th meeting in a row, and 3 officials voted to hike, the first unified hawkish triple descent in nearly a decade. And the new Fed chair, Kevin Warsh, stood at the podium and said, "I asked for a good family fight and I got one." Now everyone is reading that as strength, but there's a good reason, which I'll explain in this video, to believe it's precisely the opposite. That blend of a confident committee, hawkish dissents and long patient hold, well, we've seen that before. In June of 2007, the Fed had been parked at 5.25% for 15 straight months and sounded every bit as sure of itself. 10 weeks later, it cut by 50 basis points in a panic. Fast forward to today and, well, cracks are visible in financial markets and Bitcoin is the single most sensitive asset to what happens next. So in this video, we're going to walk through the historical pattern that says this pause might already be over, the signs of market weakness that tell us we're at a turning point, and when BTC could be kicked into a whole other gear. My name is DC and you're watching the Coin Bureau. So let's begin by looking at a historical pattern that gives us some insight into where we are today. Across every tightening cycle in recent decades, 1984, 1989, 1995, 2000, 2006, 2018, the median gap between the final hike and the first cut is roughly 7.5 months. But there's something interesting about this gap. Hawkish resolve at the top of a cycle isn't a signal of strength, it's a lagging indicator. Committees anchor on the inflation they can already see in the data, which is by definition the past, while the actual economy rots underneath them. The 2006 to 2007 sequence walked this exact path. Step by step, there was a long hold at the top. Committee members grumbling about inflation risk and then a sudden 50 basis point cut on the 18th of September 2007, the moment credit started cracking. Because when the Fed turns, it doesn't turn gently. In a normal easing cycle, you get around 235 basis points of cuts in the first 12 months. In an emergency one, up to 400, and that's a huge difference. The Fed eases all at once, and it does it after leading you to believe that it wouldn't. So that's the pattern. If you're suspicious about it, because that alone is just a narrative, we have to look at some key features of today's market that spell trouble. On the 27th of July, the 5-year credit default swap on Nvidia hit an all-time high of 82 basis points. Now, for anyone unfamiliar, a credit default swap is just insurance against a company failing to pay its debts. The higher the price, the more the market thinks something's wrong. And Nvidia is a $4.6 trillion company. This is the most profitable business in the world, and professional investors are paying record prices to insure against it defaulting. Now that number jumped 14 basis points in a single session, the biggest one-day move since the contract started actively trading. Why? Well, because Nvidia has been reportedly discussing over $750 billion in AI infrastructure commitments, including a potential $250 billion financing guarantee for an OpenAI data center campus in Ohio. And Nvidia's filings disclose a maximum exposure of $3.5 billion across all its facility lease guarantees. $3.5 billion on the books and a reported backstop roughly 71 times larger than that. So you can see why the credit markets are getting a little sensitive. But it isn't just Nvidia. Oracle's default protection is sitting above 200 basis points because of growing credit risk concerns. Meta's at 93, Alphabet's at 65, Amazon widened too. CoreWeave is at 855 basis points, which implies roughly a 50% chance of default within 5 years. As Dylan Wu at Pepperstone put it, the credit market is noticing something the equity market hasn't fully priced. But there's even more. Private credit default rates hit a record 6% earlier this year. That's the largely unregulated, lightly reported channel that swallowed almost everything the banks stopped lending after 2008. US commercial bankruptcy filings are up about 13% year over year according to first half data. Small business Chapter 11 filings jumped 50% in the first half of this year, and large corporate bankruptcies hit 372 in the first half, the highest first half total since 2010. And meanwhile, hyperscalers issued about $244 billion in bonds through mid-July, more than double the $108 billion they raised in all of 2025. The AI build-out is now debt-funded, and that debt is being repriced in a big way. Investor coverage on those bond deals collapsed from around 5 times in February to under 2 times by July. That's a massive spread, and we're only in the early innings. Keeping track of credit spreads, bond auctions, and the Fed while also having an actual life is basically impossible for any one person. So we made it a lot easier for you. Right here on YouTube, you can join the Coin Bureau Club Lite plan for just $10 a month. You get daily market updates across both crypto and traditional finance, our dedicated teams read on the most important market details, and none of the noise. Just tap the join button below this video to get started. Okay, back to the Fed, because if credit is already showing signs of stress, the obvious question is why the Fed hasn't reacted. And the answer can be boiled down to one number. The June jobs report came in at 57,000 payrolls against expectations of around 115,000. On top of this miss, 74,000 jobs were revised away from the previous 2 months. Weekly private hiring is down roughly 60% since May. And yet, despite all of this, the unemployment rate went down from 4.3% to 4.2%. How is that even possible? Well, because roughly 720,000 people simply left the labor force. Participation fell 0.3 percentage points to 61.5%, which is the lowest since March 2021. Household survey employment dropped by 507,000, and this is what economists call low hire, low fire. That means nobody's getting hired, but nobody's getting fired either. So people give up looking and drop out of the statistics entirely. And when you drop out, you're not unemployed anymore. You're just gone. So the single number that would force the Fed's hand is being flattered by a shrinking workforce. And that is the delay to consider when you're trying to figure out the state of the market today. Fed Chair Warsh himself described the labor market as steady back in June, right before that print landed. But delays like this one don't get resolved gradually, they're usually resolved very sharply. Now at this stage, you can probably imagine the big objection to this thesis. Inflation is still a problem. The Fed couldn't possibly cut here. There's a reasonable argument there, and Warsh could not have been clearer when he said there is no soft inflation target. There's only a target and it's 2%. But there's something else to consider. The Fed does not need to cut rates to flood the system with liquidity. Financial stability is a completely separate lever from interest rate policy, and one could easily argue the plumbing is starting to look thin. The reverse repo facility, which is basically the Fed's spare cash cushion, has drained from a peak of around $2.5 trillion to effectively nothing. One reading put it at $376 million. Bank reserves sit near $3.1 trillion, scraping the bottom of what the Fed calls ample, and quantitative tightening only ended in December. The Fed has already been buying treasury bills since January just to keep reserves topped up. And consider the language change in the Fed's most recent statement. They shifted to saying they are continuing their policy of maintaining ample reserves. There is no shock absorber left in the system. And this is where it gets interesting because of who's actually leading the central bank. Kevin Warsh was confirmed back in May this year. He served on the Federal Reserve Board from 2006 to 2011, which means his actual resume is 2008. He was the board's crisis operator, involved in designing and running the emergency liquidity facilities, the team auction facility, the commercial paper funding facility, the things that kept the funding markets breathing when everything else froze. That is his formative experience, so his view on markets was largely forged by the events of the global financial crisis. And right now, he's running a full anti-inflation credibility play, and he's running it very well. But if you're asking who on that committee is most likely to open the taps the second funding market sees up, it's the guy who built the taps. Now, of course, he hasn't come out and said that himself. He actually said the Fed is not in the bailout business, but any central banker would say the same thing. Resumes tend to predict behavior a lot better than press conferences do. So if we roll with this thesis, when does this actually happen? Of course, nobody can predict these things down to the day. But there are actually a few dates you want to circle big in your calendar. First, Jackson Hole, the 27th to 29th of August. That's Warsh's first keynote as chair, and he says the speech is still a blank piece of paper. But at the same time, he's running 5 internal task forces on communications, the balance sheet, the data, productivity, and the inflation framework. So to put it simply, a brand new chair with a blank page and 5 task forces is not a man planning to say nothing. Then we have another big pressure point. September 15th is the corporate tax date. Companies pay their quarterly taxes, the money drains out of the banking system into the treasury's account. Reserves fall, the repo markets tighten. And the FOMC meets on September 16th, just 1 day later, with fresh projections. So you have liquidity getting squeezed on a Tuesday and the committee sitting down on the Wednesday. So here are 3 things you want to watch between now and then. First, a sharply negative payroll sprint. Second, sustained friction in repo markets. And third, a default cascade in private credit. Any one of those and everything changes.
What if you could trade real US stocks like Apple, Nvidia, or Tesla without leaving your crypto account? Well, that's the idea behind R tokens from BitGet. These are tokenized stocks backed one-to-one by real shares, but the key difference is they are actually usable. You can trade them, use them as margin, and even earn dividends instead of just letting them sit in your wallet. So, if you want to check them out for yourself, sign up for BitGet using the link in the description or by scanning this QR code.
Okay, so with all of that in mind, how does this impact Bitcoin? If you're holding Bitcoin and you're expecting this to be a straight line up, let's remain calm and just consider how this would play out. Phase 1 is likely ugly. As you've probably heard before, when everything breaks, correlations go to 1. Everything sells at once, margin calls come in, and they force people to liquidate whatever they can actually sell. And remember, Bitcoin trades 24 hours a day. So Bitcoin often gets sold first. In March 2020, Bitcoin fell roughly 50% from around $8,000 to under $4,000. Investors dumped Bitcoin, stocks, and gold simultaneously just to raise dollars. Now phase 2. That's where the fun begins. Bitcoin reclaimed its all-time high by November of that same year and then outran both the S&P and gold for the following 2 years. And the turn often comes before the actual rate cut. Across September 2019, March 2020, and March 2023, front-end futures repriced over 100 basis points of cuts within days to weeks of the break becoming visible. Bitcoin is already pricing in the probability of the response, and it reprices harder than anything else because it has no earnings to impair, no customers to lose, and no cash flows to discount. The only variable is that USD denominator. Michael Howell at Cross Border Capital estimates Bitcoin's sensitivity to global liquidity at around 9.5 times. So the whole move happens fast, super fast, which is exactly why most people get shaken out on the road to being right. Just look at how positioned this market is for the wrong sequence. Spot Bitcoin ETFs just had their first negative half year ever, with $5.4 billion of net outflows, and June alone was the worst month on record at around $4.5 billion out. Futures open interest climbed to a 2-month high near $47 billion, and 700 million got liquidated in a single day on the 28th of July. $536 million of that longs. Retail is still net long about 63%. Options traders have shed their downside hedges. But in contrast to futures traders and ETF holders, long-term Bitcoin holders now control a record 16.64 million coins. That's about 83% of the entire supply. And they've been adding 50 to 100,000 per month, which is the strongest accumulation in 6 years. Now, we can't finish here without looking at one more thing that could, in theory, change this whole outlook. And that's the bond market. Right after the Fed's latest rate decision, the 30-year Treasury yield reached 5.2%, its highest level since 2007. And it was rising even as the front end began pricing in cuts. So the term premium, which is basically just the extra return investors want for locking up their money for longer, has climbed back into positive territory after years below zero. And we've already seen this fail once. After the Fed's 50 basis point cut in September 2024, the 10-year yield went up from around 3.65% to 4.79% by January. If term premium keeps climbing while the Fed eases, then financial conditions never actually loosen. The liquidity impulse gets absorbed by the bond market before it ever reaches risk assets. So that's one big thing to keep in mind. That scenario could invalidate all of this. Therefore, it's a good idea to keep watching the 30-year. If it keeps going up while the Fed cuts, we're in an entirely different market territory. Okay, so let's do a quick recap. Everyone is looking at the 3 hawkish descents as a central bank taking control. But if you look at history, it's very often the last position a committee takes before the data forces its hand. Over the last few years, Bitcoin was mocked as a failed inflation hedge while gold got the headlines. Except gold's down 6.5% this year too, so that story didn't work out for anyone. Bitcoin has always functioned as a liquidity instrument. And liquidity comes back the second something in credit gives way, which is what record Nvidia default protection, 6% private credit defaults, and the highest bankruptcy count since 2010 are telling us. But what do you think? Do you think Bitcoin thrives when the liquidity taps are turned on, or is this just wishful thinking? Please get highly opinionated in the comments and let us know. And if you want to understand how Bitcoin's price actually tracks global liquidity rather than the inflation narrative, then definitely check out our full breakdown right over here. As always, thanks so much for watching, and I'll see you again very soon. This is DC, signing off.